In this presentation, we will take a look at the testing of controls related to revenue transactions. Now, we're going to go through a table first. We're going to go through this fairly quickly, basically reading through this item, which I know is going to be a little bit tedious to do, but this is probably something that you're going to want to go back to and look at a few more times because these are the actual procedures. This is everything laid out, and then we'll go into some more detail about some of the key components within here. So we have the assertions. These are things like the occurrence and completeness. We have the possible misstatement. This is the misstatement, the concern of management, the weakness, the problem that the control would be trying to set up. And then we have the example of the control activity. This is the control activity set up by management, good internal controls, which are designed to solve this possible problem, this possible weakness within the revenue recognition process. Then what are we going to do? How are we going to test then the controls that have been set up? So we have the assertion. These are things like occurrence and completeness. We have the possible misstatement, the problem that could be happen with relation to this particular assertion. We have management's attempt to solve the problem with internal controls, and then our attempt to test those internal controls to see if they are indeed in place and solving the problem here. So let's go through this. We'll read through this fairly quickly, and again, we'll go through some of the key components later. This will be a little bit tedious to do, but you might want to take a table like this, spend some time with it, because this is basically going to be a layout of the internal controls themselves and relating them to the assertion, which is a point where many people have problems with. In other words, in the actual audit, many beginning auditors are pretty good at basically just knowing what the tests are or following through the checklist. If you were to ask someone to tie those out to the actual assertion, which is often done on test questions, then may have a problem with that. But within designing the audit or understanding the audit and reviewing the audit, we really need to have this understanding not just of the procedures, but how the procedures are put together and what assertion they relate to. So if we have occurrence, the possible misstatement related to occurrence is fictitious revenue. So we may have fictitious revenue that wasn't there with relation to revenue recognition. How do we control against this? The internal control set up by management, separation or segregation of duties. That's often going to be one of our main internal controls. Test of controls. What do we do as the auditor? Observation and evaluation of good segregation of duties. We'll observe it, we'll evaluate it. And then we have the other possible misstatement, revenue recorded, inventory not shipped, or services not done. The control related to it that's supposed to stop this or prevent it or detect it. Sales recorded only when there is an approved customer order and shipping document. What are we going to do in order to test that control? Testing of a sample of sales invoices for the inclusion of authorized customer order and shipping document. If there's an IT application involved in this, examination of the application control as well. We'll also take a look at numerical sequences of the sales invoices, or this is another internal control, numerical sequence of the sales invoices. That's going to be a check. What are we going to do to test it? Review the testing of client accounting procedures for numerical sequences of the sales invoices. And then if there's an IT component, we'll take a look at that. Monthly customer statement and complaints handled independently. This is going to be a piece of the control. How do we test that control? Review and testing of client procedures for mailing, handling complaints. Then we have the next assertion, this assertion being completeness. So now we're on the completeness assertion. What's the possible problem with relation to completion? Inventory shipped or services done while revenue is not recorded. So, and this would be one that we're possibly not as concerned with because this would mean that they're under-reporting revenue, and we're probably leaning towards the side that they might over-report revenue and try to look better rather than worse. But we're going to test for completeness here, which is the inventory shipped or services done. We did the work while revenue is not recorded. And obviously on the company side, this would be a concern on the company side because if something was done and the revenue wasn't recorded, then obviously that could be a problem. So we're going to say then the controls that are set up to prevent this, numerical sequences of shipping documents and sales invoices. So we should have the numerical sequences as a form of check. How can we check this as the auditor, whether this control is in place? Review and testing of clients' procedures for accounting for numerical sequences of shipping documents and sales invoices. And then if there's an IT component, checking that. We will also, another internal control set up by the company, shipping documents are matched to sales invoices. So we're going to match the shipping document to the sales invoice. How do we check that as the auditor? Tracing a sample of shipping documents to their sales invoice and to the sales journal. Another internal control related to this completeness assertion, sales invoice reconciled to daily sales report. How do we test that as the auditor? Testing of a sample of daily reconciliations. Another internal control related to completeness, open order file that is maintained currently and reviewed periodically. So an open order file, how do we test that as an auditor, that control is indeed in place? Examination of the open order file for unfilled orders. And then the next problem that we can have related to completeness is relevant and required disclosure is omitted by management. So what if there's a disclosure that is omitted? So we're going to have the internal control of a disclosure checklist that is going through, and then we can review that control by review the financial statement disclosure checklist by the auditor. Next assertion is going to be authorization. So authorization, possible problem with relation to this assertion, inventory shipped or services performed for a customer who is not a good credit risk. So there's a good credit risk, not a good credit risk, and we ship the How can we guard against that with an internal control that was set up by the company? The internal control set up good procedure for authorizing credit and shipment of goods. How can we test that internal control as the auditor? Review of clients' procedures for granting credit. And then we're going to have an examination of sales orders for evidence of good credit approval. If there's an IT component, we'll check that as well. The next possible problem with relation to authorization, shipments made or services performed at prices not authorized or on terms not authorized. What's the internal control related to it? Authorized price list and specified terms of trade. So we have an authorized price list, specified terms of trade. How can we test that as the auditor? Testing the control, comparison of prices and terms on sales invoices to authorized price list and terms of trade. And if there's an IT component, we'll take a look at that. Next assertion is accuracy. What's the problem related to accuracy? We're going to set up internal controls to help to reduce revenue transaction recorded at a dollar amount that is not correct. What's the internal control we're going to set up in order to reduce that problem? Authorized price list and specified terms of trade. We also have the control of each sales invoice agreed to the shipping document and customer order for product type and quantity. Verified mathematical accuracy of the sales invoice. And then how are we going to test for these items as the auditor? Examination of the sales invoice for evidence that clients' personnel properly verified mathematical accuracy. So we should see some kind of indication that there's a verification process. Recomputation of the information on a sample sales invoice. We'll recalculate it. If there's an IT component, we'll take a look at that. Then we're going to have the next problem that could happen with relation to accuracy. Revenue transaction that is not posted correctly to the sales journal, customers' accounts in accounts receivable subsidiary ledger or general journal. What's going to be the internal control related to it? Sales invoices is reconciled to daily sales report. Daily posting to sales journal is reconciled with posting to subsidiary ledger. How can we test that internal control is in place as the auditor? Examination of reconciliation of sales invoice to daily sales report. Examination of reconciliation of entries to sales journal with entries to subsidiary ledger. The next item, the next internal control that we can set up with relation to the assertion of accuracy is the subsidiary ledger is reconciled to the general ledger control account. How can we test for that as the auditor? Review of reconciliation of subsidiary ledger to the general control account. Next assertion, these are the last three here, it's going to be the cutoff, the assertion of the cutoff. So at the end of the year or the beginning of the year, the cutoff periods. Possible misstatement with relation to the cutoffs is revenue transactions recorded in the wrong period. That's the problem. How do we solve that as the company that puts in the internal control? all shipping documents forwarded to the billing function daily. So we're going to have the daily process so that it's going to be recorded, same day. And then how are we going to test for that as the auditor, that the control is in place? Comparison of the dates on sales invoices with the dates of the relevant shipping documents. And then the next internal control, daily billing of goods shipped. So we want to be billing daily. We don't want the lag time happening here. And the examination of that internal control as the auditor, comparison of the dates on the sales invoices with the dates they were recorded in the sales journal. Then we have the next assertion of classification. Classification, possible problem related to it. Revenue transactions that are not properly classified. Revenue transactions not properly classified, that's the problem. What's the internal control we can put in place? We want to have a chart of accounts. How can we test that chart of accounts as the auditor? Review of sales journal and general ledger for proper classification. The next internal control we could have related to classification, proper codes for different types of products and services. What's the procedure we can do related to that control? Examination of sales invoices for proper classification. If there's an IT component, we'll take a look at that. Finally, last assertion, we have presentation. Presentation, what's the possible misstatement with relation to that assertion? Revenue transactions that are not properly presented and disclosed. What's the internal control to guard against that? A chart of accounts. How can we test that as an auditor? Review sales journal and general ledger for proper aggregation and disaggregation of revenue transactions. Determine if disclosure is needed. Examination of sales invoices for proper aggregation and disaggregation. Check if there's an IT component to it. Test that. Review disclosure checklists and related disclosures for relevance and completeness. So again, we went through this pretty quickly, but these are probably a table you want to spend some time with. If you can understand this table, you get a good idea of the assertions, the problems related to it, the control that would be put in place by the company, and then our testing of that control. Because remember, what we want to do as the auditor is be able to rely on the controls to be able to handle some of these assertions and therefore be able to do less substantive testing. Now we're going to take a look at a few more components in a bit more detail. The auditors need to be occupied by two types of material misstatements related to the occurrence of revenue transactions. Now remember, as auditors, we're often skeptical that the financial statements are going to be somehow overstated most of the time. So we're usually more concerned, leaning towards the concern of some type of overstatement happening. The largest type of misstatements that could happen would be due to something like fraud or something like that. And in that case, you normally would think that there would be some attempt to overstate. In the case of revenue, that would mean that you would try to make more revenue, make the revenue higher than it might otherwise be or it should be. And therefore, if we're considering the occurrence of revenue, that's what we're considering. We're considering, hey, is there something on the revenue? If we go from the revenue back, if we go from the income statement account of revenue back to the actual transaction to see if it should be there, should it actually have occurred? Did the transaction actually happen to create that revenue? That's one of the things that we're most concerned with regards to revenue. And so what our concern then is going to be with a sale to fictitious customers. And you can imagine a company saying, hey, how can we increase revenue? Or it could be an error as well. But if you're thinking about fraud, you could say the company, and this, when as an auditor, of course, we're always considering what could happen and then thinking about how could we test for it, what kind of control should be in place. Well, it's possible that a sale is put in place that's fictitious. A sale to a fictitious customer would be the easiest way to look good, right? You would say, oh, here's a sale to a customer. We're going to record an increase to the sales revenue, and we're going to record an increase to, say, accounts receivable. We don't need to have any actual thing happen. Cash didn't take place or anything like that. That would be a fictitious sales that would increase the revenue. That's a concern for us as the auditor, of course. Recording revenue when inventory has not been shipped or services has not been done. Now, this is a similar type of thing, but it may not be basically the same thing. So obviously, if we're talking about a fictitious sale, it's probably the case that you have some type of fraud, a sale that didn't actually happen, a sale that was recorded. If we're recording revenue when inventory has not been shipped, it may well be a legitimate type of sale that happened, but the inventory has not yet gone out. And again, this could have a fraud component, or it could have an error type of component to it. So for example, you can imagine a company trying to say, well, I want to increase the sales in this certain time period. I'm going to sell to this individual over here, but I want to basically push these sales into this time period, this year, making a timing issue, try to put it before the December year end by basically recording the sale or making the sale transaction before the time period. And even though the goods are not shipped, and the transaction therefore not completed until after the time period. Or it could just be a timing difference where we basically have a system where we record the revenue as basically we have an invoicing process, and possibly the invoicing happens before we do the shipping of the goods or something like that. And in that case, again, we would record the sale. It's possible for a sale to have been recorded before the goods are shipped or the service is done. And if in that case, of course, that's a problem, because we shouldn't be recording revenue until the work is done in accordance with the revenue recognition principle. So this is going to be our kind of cutoff testing right there. We're going to try to say, look, these ones that are close to the cutoff generally, the question is, did we do the work in that time period? And the work isn't just going to be sending out the invoice. The work is typically shipping the goods or doing the services under the revenue recognition principle. And then we have the revenue transaction related to the completeness assertion. The large concern is that inventory is shipped or services are done and no revenue is recorded. So it's possible in this case that we have some type of shipment. The shipment actually happened, but the revenue wasn't recorded. Now, again, we might not be as concerned with completeness as we would be with the occurrence transaction with regards to revenue, but we have the same kind of issue with the timing type of issue. It's possible that we have some kind of difference between the timing issue of the shipment and the billing process, in which case that we have some transaction that actually did occur, the work was done, and it wasn't recorded in the proper time period, usually going back to our cutoff type testing. The controls include numerical sequence of shipping documents and sales invoices, matching shipping documents with the sales invoice. So we should be having the sales invoice and the shipping document matched up, reconciling sales invoices to the daily sales reports, and maintaining and reviewing the open order file. Then we have the revenue transactions for authorization and accuracy. So we're considering the assertion authorization and accuracy. Possible misstatement due to improper authorization includes shipping inventory to or doing services for customers who do not have good credit risk or are not good credit risks, and making sales at unauthorized prices or terms. So obviously this first one is, if we made sales to people that have bad credit, then it's possible that we're going to have an increase in the amount of bad debt, and that's going to be, of course, a concern. It could be possible that if we're purposely making sales, it could be a potential for fraud too. If their sales were being made to people who have no intention of paying, that didn't go through a credit check, that could be something that could be manipulated for fraud as well within an organization. So we want those credit checks in there. Typically, making sales at unauthorized prices or terms. So that would be a problem. Again, we can see that there could be some type of fraud involved in that if that was the case as well, right? If there's a situation, there's no checks involved, and sales were going to be made at some type of unauthorized price, possibly lower prices, then that would be a concern. The existence of an authorized price list, so we should have an authorized price list and terms of trade, reduces the risk of inaccuracies. And the sales invoice should also be verified for mathematical accuracy, so we should be verifying the mathematical accuracy of the sales invoice before being sent to the customer. Revenue transactions for cutoff, so the assertion now being cutoff and classification. Sales can be recorded in the wrong accounting period if good controls are not in place. So we're thinking about basically the end of the time period, the beginning of the time period. We want to make sure that the sale is recorded in the proper time period being in accordance with revenue recognition. All shipping documents should be forwarded to the billing department. That's going to be the control. The use of a chart of accounts and good codes for recording transactions should provide enough assurance about the proper classification of revenue transactions. Then we have the assertions of presentation. Auditors' tests of controls regarding management's use of good chart of accounts, good codes for recording revenue transactions, and the financial reporting process, including the use of disclosure checklists, should provide adequate disclosure for presentation assertion.